These big financial names out there might be some of them that are synonymous with negativity. This industry definitely has a stereotype around guys like me.
I know.
They're like, oh, can I trust this guy?
Yeah. No,
Like,
I mean,
you hear the word attorney, what do you think of?
I just met you 10 minutes ago and I want to give you money right now.
What, in your mind, are the 3 best stocks as of right now that you like to invest in?
All right, so
Would you tell your client to invest even though they're in debt?
I would tell them they got to get rid of that first. And here's why.
What would you say is a typical minimum that somebody should be investing each month?
And I've got clients that are putting in thousands of dollars a month. I've
Okay.
got clients that are putting in $100. Got some clients that are putting in nothing, but they gave me $3 million.
Is there like a contract that you have your client sign for a certain amount of money that they have to put in each month?
That's a good question.
What's going on, guys? Welcome back to another episode of the Think About It podcast. Today, I'm excited. We got a financial advisor, the owner, Mr. Kyle Williams from Synergy Wealth Alliance. Man, what a kick-ass name that is. Kyle, welcome, sir.
Thank you. Yeah, appreciate you having me on here today.
This is a good one, Joe. You lined this up, man. I'm excited for
it,
this.
man. I'm excited. I know your energy. I know your energy. I know you both.
But you know what? You know what I'm excited about? Like, you think you know about money until you get someone who does it day in, day out. You know what I'm saying? So, like, the more knowledge I can get, Kyle, I'm happy to go with it,
Y'all
man.
are really putting the pressure on me here.
No. Hey, look. I mean, I'm sure you know something that I don't know, and I'm all ears, man.
Yeah.
You know,
your experience with day trading and everything,
Yep.
plus my experience from working with the mom and pop and
sure.
things like that, and looking at things from sometimes a little bit more conservative point of view.
Yep.
The intersection of that, I think, will be good content for you.
that's what I want to hear. You know, because
Yeah.
in my head, I don't even have a 401k or Roth IRA. I create my own wealth, right?
Mm-hmm.
And that might be the wrong way. That's why I need a guy like you to talk to me. You know what I'm saying? And that's why you're here, because I've been spitting all the knowledge that I have, and it might be wrong. And someone might be out there and they're like, 40, 50, 60, 70, whatever it is, and they don't have that. They don't have a retirement lined up. And they might need to talk to a guy like you, you know? So
real quick, before we actually get started, we already gave you an introduction, but kind of introduce yourself a little bit.
My name is Kyle Williams. I'm 44. My wife, Amber, I think we've been married for 16 years.
you better know how many years.
I think maybe this year is going to be 16 years. 3 kids, 13, 11, and 5.
Beautiful.
Had a preschool graduation today, so that was
Wow.
Oh,
that
nice.
was fun.
That's awesome.
Live in Altamont. Been in Florida for about 22-ish years.
Okay.
From South Mississippi originally, so that's where my southern accent.
I was going to ask
and
that.
the good looks. That's where that comes from.
It all makes sense now, man.
Yeah. So I think at this point I've been in Florida more than half of my life. And when I got married, that's when I decided to make the move into the financial industry.
Okay.
I was in a completely different industry altogether: audio-visual integration, marketing and sales, and project management for a company that did jobs for like Disney, Universal, Six Flags, stuff like that.
Oh, wow. Nice.
So got a lot of exposure to some neat stuff in that world. But when you got married, it's like, I don't know if this is really going to cut it to be able to grow up with that lifestyle that I grew up with. And,
For sure.
I didn't have a silver spoon, but I didn't have a whole lot of struggles. Okay. So, I wanted to be able to provide for my family the same way that I was provided for.
Yes, sir.
And the financial industry was one of those things that my dad was in. And said, okay, well, I think that I've got the personality to be able to connect with people.
100%.
And if I've got the aptitude to understand and be able to communicate that to people, then it's a win-win. I win because I can grow my business, and people are going to win because they're going to have sound advice and somebody that they can trust. Because that's really what it comes down to. You do business with people you like and you trust.
Yeah. 100%.
And so that started about a year after I got married, I think. So
I just met you 10 minutes ago and I want to give you money right now.
All right. Shit. Yeah.
Like, I was like, hey, what's going on? He walks in and we just started talking.
Make that check out.
I was like, Sean, get out of here. Leave.
It's been a kind of an interesting road, because I got into this world with Edward Jones. I mean, everybody's heard of Edward Jones.
Yeah.
They're a great brand. They're a great company. They're an ethically and like morally sound company.
Edward Jones, Sean Schwab.
When you think about some of these
right
big financial names out there might be some of them that are synonymous with negativity. And so when I left Edward Jones, I did get into the bank world, still as an investment advisor.
Sure.
But bounced around to a couple of different banks until finally COVID kind of forced my hand. And I decided this is kind of a sink or swim type moment. Now or never. I gotta make the move now, because if I don't, then I don't know if continuing in the industry is really going to be possible.
Love that.
So it was. I mean, my wife was not so sure about that, because she was thinking, this is we've never
dangerous move.
experienced anything like this.
Yeah.
What's going on? You're really going to leave this job with this company that has a big name and kind of go out on your own? But she believed in me, and 5 years in now, independent, and things are going well and thriving.
I think a lot of people during the pandemic were forced to figure it out.
Yeah.
I think you had no other choice.
Yeah.
You were home. Shopify went through the roof during the pandemic. PayPal was going crazy. Why? People were getting stimulus. People were home getting checks. People were home spending money, and people were getting creative.
Yeah.
That
type of thinking is one of the things that I like to do with my clients. Is
See?
to say, well,
Yeah.
what do people need right now?
Right.
What are people using right now? Where do we see things going? And can we get into some of those things now?
For sure.
You don't always have to get in at the ground level. I mean, IPOs are great, but there's also a huge risk that's associated with that. So
I just got into an IPO that's doing phenomenal.
yeah,
CoreWeave. Have you heard of it?
have not.
CRWV.
No, I haven't.
NVIDIA has 78% of it.
Okay. So there you nailed
AI.
NVIDIA. It's
Yeah.
like, okay,
Yeah.
what space are they in? Tech, AI,
It's tech, yeah.
robotics,
Yeah.
what have you. All of those sort of things are only going to continue to grow
Yes, sir.
exponentially.
100%.
So
Absolutely.
I've got a couple of ideas that I'll share with you today. And I think that when we do some kind of like look at the numbers type comparisons, it's not some earth shattering ideas or recommendations, but it's kind of some common sense.
For
Like,
sure.
hey, if this is what this has been able to do over a longer term time frame, then imagine what that could do if you marry that to some, sound, fundamentally diversified type portfolios.
Yes, sir.
The boring stuff.
Of course. Yeah.
You can have exciting stuff and boring stuff married together and have a great experience. It doesn't mean that you're going to be making 100% returns.
No, of course.
And things like that. But if you got people that are looking to get into investing, or they just want to make sure that they understand that they're not going to hurt themselves. How can I get into investing, learn the ropes, get some experience, and then figure out what is my fit? Then I think that some of the things we look at today will help those people.
So your job title is financial advisor.
Yes.
What do you have to do to get those credentials to become a financial advisor?
So I've got a handful of different licenses. I've got a Series 7 license, which lets me do general securities, so stock trading, stuff like that. I have a Series 66. It allows me to be a fiduciary. So like one of these other buzzwords you start hearing, fiduciary. Like, what does that mean?
Never heard
it
that
means that I am required to act in the best interest of my clients. And
sense.
whenever this whole rule is, there's a regulation that came out called Reg BI, best interest,
That makes
which
sense.
says the advisor is required to act in the best interest of the client. And I was like, I mean,
Yeah.
duh.
Yeah. That's
Like,
the point, right?
People were freaking out.
Yeah, yeah,
They were
yeah.
losing their mind. Like, what do you mean? They're going to be looking over our shoulder. And I was like, if you're not doing anything wrong, what are you worried about, man?
Yeah.
It's like the old man that's like, I don't like him cameras looking at me. And you're like, well, if you're not doing anything wrong, why are you worried about the camera?
Yeah.
So Reg BI comes out and it says best interest standard. And this is when the whole fiduciary standard started to become really a hot topic, where it was always implied that you would be acting in somebody's best interest, but there wasn't any sort of checks and balances or accountability. So now there's all these checks and balances. I love it, because it makes me go, I'm not worried about anything. No one's ever going to be able to accuse me of any sort of wrongdoing, because it's in an account that protects them and me from that sort
Yes,
of
sir.
thing.
Yep.
So, high commission products, stuff like that. There are still ways that I get paid from a transactional standpoint, but I would say probably 85% of my practice is advisory asset management, which is, professional money management where it's in a fiduciary capacity.
Okay.
So that's one of the kind of the big buzzwords that came out. So this other license, that Series 66 license, is what allows me to act in a fiduciary role when it comes to managing people's money. So I've got that license, the Series 7 for general securities, and then I've got the 215, which is a life health variable annuity. So I can do insurance
Nice.
type products. So those are the main three. that I have that allow me to do this. And, you know, you got to do all the continuing education and stuff like that for it. But, you know, there's new things that come out every now and again. And those licenses hold you accountable to know what those new standards are. So, you know,
sense.
just like how doctors have to
Sure.
to do these things, because if new stuff is coming out and they're like, yeah, I'm going to do it the way I was doing it
Yeah.
50 years ago.
Yeah.
You're like, what? Now there's new rules that you kind of need to know about. That that's kind of where that is. But it's a great career, because if you're a people person,
For sure.
then it gives you an opportunity to really interact with a lot of people, and it gives you the ability to just listen, help them make good decisions with their money. You ever heard of Ziglar?
No.
Zig Ziglar?
No.
Inspirational speaker. I think he's passed at this point, but he's got a bunch of little one-liner quotes. And one of my favorite ones is,
Uh-oh. I love quotes. I'm ready.
he says, you can have anything in life you want if you help a lot of people get what they want.
Ooh.
I'm like, yeah. So I mean, that's what this industry is all about.
Man, I love
like,
that.
help people get what they want. What do they want? They want to grow their money. They want to make it safe. They want to be able to be secure in retirement.
You
pass
can
it
get
on to their
anything
family.
you want if you help other people get whatever they want.
That's it. That's bottom line.
Damn.
It's kind of like, I mean, it's almost common sense.
It
when you
is.
think about
It is.
right?
Yeah, yeah, yeah.
It's kind of like the golden rule. It's like, treat other people like you want to be
That's
treated.
it. Yeah.
You know, it's not a whole lot different there, but that's kind of how I run my practice is, you know, just do the right thing. Because this industry definitely has a stereotype around guys like me.
I know.
Like, oh, can I trust this guy?
Yeah. No,
Like, I mean, you hear the word attorney, what do you think of? Do you think of like a liar, or do you?
Yeah.
But you got to think, Kyle. People are coming to you with their life savings, or they're in their 20s and they want to start putting money towards their retirement.
Right.
How can I trust you for the next 30 years
Yeah.
with my money? You know, like,
Yeah.
So you have to build that trust in that relationship. You have to have a clean slate and a good track record for me to come to you and be like, hey, this is what I got. What can you do for me? And I get that. I
Yeah.
get that, you know?
Yeah.
So people always try to throw me money. I'm like, no, go see a financial advisor, bro. Like, I'm doing okay with my money. I'm not touching your money. I'll tell you how I
Yeah.
did it, but I won't touch your money. I just won't.
Yeah.
I'm not.
One
No.
of the things that I like about the business is it's actually more psychology than it is finance.
Okay.
Because I will give people recommendations because that's what they want from me, but I won't tell somebody what to do. I will give them the things that I think would be good for them.
Sure.
And then I let them make the decision based
there.
on how they feel about it. So I'm not selling them anything. I'm
Right.
saying, based on what you've told me, these are the things that you should be considering. These are the things that are going to do what you want to do over this time frame. Safety, access, growth.
There you go.
The main three things everybody wants. You want that. Everybody wants that. A little old lady wants that. The difference, though, is that we're in our 40s.
Right.
Growth, number one. Access is probably number two. Safety is not really even on the radar very much for you.
No, not at all.
It is for a lot of people, but it's a lower priority.
Of course.
You got 78-year-old widow that comes in. Well, safety's probably number one. Access is right up there with it. And
sir.
she wants to grow the money, or she wouldn't be there in the first place.
course.
But
Yeah.
she's not out there trying to wheel and deal.
No, not at all.
So trying to identify that sort of a thing is a big part of what I do.
Comes at you with $1 million and she's like, can you get me 8%? Can you get me 8% annually?
And you know what? It's not that unachievable.
It isn't. It isn't. It isn't.
And
It isn't.
you know, have you ever heard of the rule of 72?
I've heard that saying, but I don't know what it means.
This is something everybody pay attention to. This rule of
Ooh,
72.
let's go.
Okay, so give me an average annual return.
A
Pick
realistic
number.
one?
Yeah, realistic.
12%.
12. Perfect. I
Yeah,
like that number.
yeah,
You know
12.
why?
Why?
Because 72 divided by 12
Yeah.
is 6.
Yeah, yeah.
So if you're getting 12% on your money
Right.
compounded, you will double your money.
That's
in
my favorite word, by the way.
compounded.
Compounding
Yeah.
is
You
my
will
favorite word.
double your money in 6 years. Flip them. 72 divided by 6. If you're getting 6% on your money, how long is it going to take to double it? 12
years.
So if you're getting 2% on your money, it's going to take you 36 years to double it. So you got
that's
these people that are
beautiful.
like, oh yeah, well I've got a savings account and I'm getting whatever percent. I mean, savings rates right now aren't too bad.
It's
But-
the highest they've ever been, if I'm not
the-
mistaken.
yeah, I mean, I can remember back when we were in high school, probably when it was like 6 or 7%.
Yeah, but, I mean,
But those days are long.
yeah, that's done. That's
and
done.
rates will start to come down. A little
And
bit.
interest rates on homes back then were about that high and higher.
Yeah,
than that.
I mean, back when we were like the Jimmy Carter era,
Yes.
is when you have, I mean, buying a home was unaffordable at a 20%
Yeah.
interest rate at the time. But people that had money that were getting, 18% on their
It
CDs.
just made sense. Yeah. It made sense.
FDIC insured.
Yes, sir.
Raking in that interest.
Yeah.
But if you were somebody that was new to the game,
Right.
new to saving, you didn't have money to invest. And you're
no,
like
sir.
sitting there salivating over these high interest rates, but you couldn't take advantage of them. But the little old lady that had all this money was able to grow it in a super safe way. Those days, I don't know that we'll ever be back to that again, and I hope we aren't.
Yeah.
But that rule of 72 is important to be able to really start to understand the power of compounding. Is that if you're getting 4 or 5% on your money, I mean, that's not terrible for a certain asset class.
Love that.
But it's going to take you how long to get to the point that you want to be. So that's just kind of an easy one. I mean, everybody can do that math real quick in their head.
What do you say to people that go, but I ain't got that kind of money?
Well, so it's kind of back to that dollar cost averaging deal, right? So it doesn't matter how much you have. You don't have to have $1 million to get started. Start with what is accessible to you.
I say that all the time.
Yeah.
Get rid of that cup of coffee that costs you $10 a day. Stop doing that.
Yeah.
Make a cup of coffee at home.
Yeah.
10 times 5 is 50. 50 times 4 is $200 a month.
Yeah.
That you're throwing away. Take that 200 times 12 is 24.
Amen. Preach.
2,400 compounded. Yeah. Let's talk about it.
Yeah.
Like seriously,
Yeah.
it's the small. There's no change if you don't change.
Yeah.
Nothing will ever change if you don't change.
Yeah.
You have to change. People are like, oh man, I get paid XYZ, and by next Friday I'm already broke.
Mm-hmm.
Something isn't right there.
Yeah.
What is it? Let's sit down for a minute and break it all down to me. What is this? What's this? Oh, because you don't need this. This is a want, not a need. X that out. X this out. You're 25 right now. If you want to retire by 50, you got to start right now. I'm assuming, and I think $100, $200 a month to start in your 20s is great. It's something. But I also think that, quote me if I'm wrong, but once you start seeing it growing, it just does something to your stomach where you're like, oh man, I'm gonna throw more and more. Because that's the way I started. Like I still remember my savings account was like a little $10 here, a little 20 there. And then, it wasn't doing anything. But the moment I started investing and I saw what compounding started doing, it changed my whole perspective with money.
Well, it's a behavior.
100%.
That becomes
it's
a
discipline.
habit.
Yeah.
Like people that want to get into like exercising or whatever.
Yeah.
And at first it sucks, right? You're like, man, I hate running or whatever, right? But after a while, you're like, hey, I'm kind of liking this, and I'm seeing some results from it and stuff like that. And then all of a sudden, it becomes just part of the fabric of who you are, sort of a deal. So those kind of behaviors are huge when it comes to just starting with whatever is like. Don't put yourself in a position where it's going to hurt you. Don't do without the things that you have to have. But if you've got some wiggle room in your budget and you
100%.
can get a little bit, I guess, tighter with where the outflow's going, and you just put a new category there and it becomes your investing bucket, then you're gonna see some pretty substantial growth in it over time.
You know what I've noticed in our community, which is the sneaker community.
Yeah.
The more you make, the more you spend.
Yeah, absolutely.
Yeah.
Like you were living perfectly fine off of 50 grand. Now you got this education. Now you just got a raise. Now you're making 90. Their money savings has not changed at all. It's nothing. There's nothing there. But now they got a nicer car. They got the 3-bedroom house from a 2-bedroom. Like everything just goes up and up and up. I think that's the wrong way to live.
That's kind of our community, though. That's
Yeah.
kind of a look at me community.
I don't think it's
That's
just
not the
your
sneaker
community. I think that is in general just the Western culture.
Social media has done that
Yeah.
too. Social media is like,
Yeah.
oh
Well,
man,
have you ever heard the phrase comparison is a thief of
thief
joy?
of joy, of
Yeah.
course, yeah.
So I mean, you look at them, you're like, oh man,
I want that. I want this. Yes, sir.
And
Yes, sir.
the next thing you know, you're like, oh, I could get that. And it's like, okay, yeah, you could probably get it, but it's going to cost you $1,100 a month
Yes,
to get
sir.
that thing. And if you've got $1,100 a month in your budget, maybe ask the question if you'd be better off with something that was $500 a month, and what's this $600 a month going to do?
Yes, sir.
Compounding for you. So those kind of just logic and thought process is going to help with that person that says, well, I don't have a whole lot to put away.
Right.
Well, once you get some of your debts, if there are any, cleared out, start taking that and putting it towards something that can grow.
Well, that's where I was going with the more you make, the more you spend. You probably went from a $500 car note to now a $900 car note because you're making an extra $40,000 a year. And now your vacations went from $4,000 to $9,000 a year because now we want to go to Dubai with the whole family, and it's like, bro, just go to the Bahamas. It's right there. I promise you. Like, but people just want to let you know I got money.
Yeah.
And that's a shitty way to live, man. It really is.
Yeah, I agree with you. I think that it's definitely I wouldn't call it a sickness, but it's definitely
A mindset?
a mindset.
Yeah, for sure.
yeah.
Absolutely.
That's a
man.
good way to put it.
Absolutely. Talk to us, Joe.
So if somebody right now, you got a 25-year-old that comes to you, it's like, hey, I decided I want to start investing. What are the processes to get you to be their financial advisor? What's the next step?
So I'm not really an advisor that has account minimums. I mean, you start with nothing. And one of the reasons I do that is because you never know who you're going to meet.
True.
And next thing you know, they're like, oh, well, I inherited this money from my grandma, or I know so-and-so, and they, I want to introduce you to them. So I've never been somebody that turned my nose up at somebody that didn't have a whole lot of money.
Appreciate that.
And
That's awesome.
there's been some networking groups that I was in the past where that was actually an asset to me, is that they felt like if they were going to refer me, that somebody didn't have to have $250,000 to come see me. So what we need to find out in that interview process is, do I like you? Do you like me?
Yeah.
Can we work together?
Can we work together?
Yeah.
Are the things that I'm saying clicking with you?
Yes, sir.
Or do I see that the things I'm saying are clicking with you? And is this going to be a good relationship professionally to be able to guide you? Or is it going to be just like button heads the whole time?
Right, right.
I'm a pretty easygoing guy, so most times I don't have anybody, giving me too much of an issue there. But, getting an account set up and then finding out what type of growth are they pursuing. And if they've never had any experience, Joe knows this about me. I love analogies,
Okay.
right? So you ever eaten Thai food?
Sure.
Okay.
Yeah. Oh, yeah.
Have you ever accidentally ordered it Thai hot?
Yes. Dripping. Just
Mistake, right?
Oh, my God. Yeah.
So this is the person that's like, hell yeah, let's get into doing some day trading, and I'm gonna buy all this super aggressive stuff. And next thing you know, they lose their shirt and they're burned, and they're like, I'm never doing that again.
Yeah.
I'm never gonna eat that Thai food again.
Yeah.
Well, had you started out with the mild or the medium and kind of worked your way up, you might actually get to the point where you're like, I like hot. And I think I might actually be okay with a little bit of the Thai hot.
I'm more of a Buffalo QQQ guy.
I love that you said QQQ. QQQ is one of the things I want to
And then if you want to get a little bit more spicy, you go spy. Like, see, Kyle gets it.
I'm gonna talk about QQQ.
He gets the analogy on
So
that
that's
one.
something that I think young investors can definitely grasp onto
ETFs are
from the standpoint of how it's made up and what its track record is, what its
sir.
history is, what its beta is.
Yes.
So again, coming back to some of those words, what its PE, all those different things. When you look at all of those metrics and understand what am I investing in, that's the other thing. I think it's really important that people understand what the thing is that they've got.
Yeah.
Not just like, oh, this guy said to get this. I mean, you could probably still be successful if you
Sure.
buy the thing that
Sure.
somebody that has, and you stick with it, sort of a deal. But people definitely, I mean, everybody's heard buy low, sell high.
right.
People often buy high, sell low.
Low. Yes.
Happens
Yes.
all the time.
Yes.
That's that I bought Thai hot.
Yeah.
And all of a sudden I'm like regretting it. And I'm like, do I just bail?
I got a buddy who just bought a call 2 days ago, and it's down 20%. He's like, I'm selling. I'm like, it's a 2-month out contract. What are you doing?
Yeah.
Shitty news just hit the news, and you know how that goes. The news goes according to the stock market. If anybody comes out and says anything nasty, the stock market tanks.
Yeah.
Calm down.
This is why
we're in the middle of
understanding the
negotiations
beta
right now. Yeah,
is going to be
the
important.
numbers are there. Everything is there. Calm down.
Yeah.
It'll go back up. That's why it's a 60-day contract. But
Yeah. I like things that have a time frame
Yeah,
attached
for
to
sure.
it, because during this last downturn, I only had a few clients that sold.
I was gonna ask you that.
I
How was
only
your
had a
phone?
few.
Your phone must have been going crazy back in April. Kyle, what's going on,
It
Kyle?
wasn't.
Kyle, what?
Do you know why? Because I feel like I had not not trained them, but I
Informed
had,
them enough?
I had,
Trust, we're good.
I did make a lot of phone calls.
Sure,
I
sure.
made the phone calls.
Okay.
Last thing a financial advisor wants to be doing is answering the phone.
So-
I respect that.
I don't mean to cut you off. We're gonna come right back to it. But when people are wanting to reach out to you, is it you they're reaching out to, or do you have a team that they might speak to somebody else other than you?
Me.
It's
get
you.
me.
Oh,
All right,
wow,
back
that's
on
awesome.
schedule.
So
That's
I do have some other support staff, but when it comes to, any of the triage, any of the, getting to know somebody,
Yeah.
I want to do all
For
that.
sure.
I want to
Sure.
be the one that understands the person's
Yeah.
experience, background,
Love that. I
all
love
of
that.
their circumstances to give me a really good feel that I really know who I'm dealing with.
Yeah.
So I can put a stamp on like, yeah, this recommendation I'm giving you is solid
Yes,
for
sir.
you.
Yes,
Might
sir.
not be the right thing for your neighbor, or your best friend, or whoever, but this is right for you, sort of a deal.
There you go.
So there's not really a very difficult process to answer the rest of the question.
Yeah.
Is that the process is pretty simple. Identify, are we going to be a good fit to work together? Identify what can you afford to do, and if you've got some money that is set aside that you want to put away, then let's look at how much. Let's kind of analyze that safety access growth. So the access side of things. I had a younger client call me up recently and say that she needed to cash out her account, and I knew that she had a good amount of other money.
Okay.
And I was like, well, hey, what about this other money that you had? I mean, this is of the accounts that you want to be cashing out. It's not this one, because it was like right a week or so after, or right before the whole bottom dropped out back a month
She
ago.
wanted to cash out at the bottom?
She wanted to cash out as things were going down because she said, I need it.
Oh, okay. It wasn't fear. It wasn't
a fear
fear.
thing.
Okay,
Yeah,
okay.
she's like, I need it for XYZ.
XYZ, sure.
And I was thinking, like, you got $100,000 at the bank. Like, why? This is not the account to cash out.
Right.
Well, that account had a lot of illiquidity characteristics to it.
Okay.
A lot of penalties associated with it. So, I mean, looking at it, even though it's the last account she should have been cashing out, because of these other things, she was kind of forced to cash this one out because the other one would have been a bigger negative impact to her had she cashed that one in
Gotcha.
than the one she had with me.
Why not borrow against it?
So I think that the type of money that she had was
Couldn't?
it was not leverageable.
Legible. Okay. Yep. Okay.
So,
okay.
and it was kind of a short term
Yeah.
goal that they
Gotcha.
needed to be able to
Gotcha.
satisfy with it.
Yeah.
And it wasn't a ton of money that she had with me. She could have gone on margin and like taken and borrowed against it with me.
Of course.
But it was a relatively small account.
Okay.
So, identifying what are all of those, touch points.
Yep.
And then, getting an account open, pretty easy. Be a U.S. citizen and have a U.S. address.
That's it.
That's pretty
Yeah.
much it.
Yeah. Pretty
You got
much.
money, then we
good to
we
go.
can find a home for you.
Yeah. Oh yeah.
Yeah.
For sure.
Is there like a contract that you have your client sign for a certain amount of year, a certain amount of money that they have to put in each month, or how does that process work?
That's a good question, because people might think that there is. There's no implied time frame, contract, nothing.
Okay.
You're completely free to fire me at any point. You're completely free to access your money at any point. Most of the things I do don't have any sort of time frame teeth in it,
Gotcha.
where it's going to ding you if you got to get to it. And if it does, then we're going to do the math ahead of time and make sure that you're not painting yourself in a corner. So it's pretty simple.
So if you don't, I don't know if you can answer this or not, or if you can just talk about it in general, but how much or how does a pay structure for a financial advisor work? How do you get paid, and is there a certain percentage, or is it
yeah.
a fee per month? Or
Yeah, so I mean, there's two main ways that I get paid. So there's either transactional, which is kind of the older school way of doing things, and then there is
Percentage.
fee-based,
Yeah.
which is that whole advisory,
Yep.
fiduciary type management.
Yes, sir.
Is where it is a percentage based on the value of the account.
Yeah.
Okay.
So what this does is it puts me and the client on the same side of the table.
Yeah.
That you're never going to ask the question, is this better for Kyle or is this better for me?
Me.
Yeah.
Yeah.
Like, why is
It's
he
always going to be
recommending
better
this?
for the cut.
There's
Yeah.
never going to be a bias,
Right.
Because if your account goes up, you're happy.
That's it.
I'm happy.
I'm happy, of course.
Your
Because the
account
more
goes
you make, the
down.
more I make. Yeah.
Yeah, but
course.
what happens if your account goes down?
That's a good question. That's a great question.
My
That is a good
paycheck
question.
goes down.
Oh, okay.
So you can bet your ass that I am.
Your job is to
interested.
make sure that it stays in the plus.
I'm interested in the prosper of your account.
For sure.
That's what you want your advisor to have a stake in your success. So that's how it works and so I think I was saying this earlier, about 85% of my practice is in that fee-based world. Every now and again, there are transactional type things like different types of annuities or unit trust, or just individual stock trades sometimes that can generate a commission. But commissions aren't bad, okay?
Sure.
It just needs to be suitable. It just needs to be
course.
appropriate. So if it is and it's justifiable and the client understands and agrees all of the terms of it, then all good. But most of how I get paid is from a fee-based standpoint. So I'm looking at my overall assets. You'll hear the term AUM, or assets under management. That's the big figure that will help identify what the bulk of my income is going to be based on.
Okay.
And the
like that.
percentage that somebody is paying is negotiable. So it kind of depends on the level of growth that they're pursuing. Sometimes more growth-oriented things, there's a little bit more moving and shaking. The fee might be a little bit more.
That makes sense.
I typically try to keep it similar or real close, even if it's a super conservative person or more. So it typically in the industry is somewhere between 1 to 1.5%.
I was going to say almost 2%. Yeah.
Yeah. Two is getting high.
Yeah.
I don't have any clients at 2%.
Okay.
1 to 1, and maybe I'm leaving money on the table, but what do I think is fair?
Yeah, I think that's fair. I think the 1 to 1.5 is fair. For sure.
So, and it's kind of easy math too. Every now and again, I come in a competitive situation where somebody's like, well, hey, XYZ is going to do it for this. And I'm like, well, if you like me and we can do business, I can match the price. I'm not gonna lose the relationship over a couple of bucks.
If I got $1 million to give you and you can get me back 10% annually compounded, geez, that's we're looking at $100,000 a year. I got no problem with giving you 15 grand and keeping 85. Even after taxes, it's still beautiful, bro.
Yeah.
To me, that's good money. That's good money.
I like that thinking too, because some people do kind of. You ever heard the phrase "penny wise, pound foolish"?
Yes, sir.
Right. So it's like they're like you're spinning your wheels, worried too much about what the cost of it was when you could have been letting somebody else do the thing for you.
Yeah.
And probably get better results. You're removing a lot of the emotion.
The stress, yes.
Okay. So they're removing the emotion. Now, my job is to be objective.
Yes, sir.
The client is often, it's difficult for the client to be objective. There's a lot of subjectivity with the client. They come to me, I'm supposed to be that calm in the storm. I'm supposed to be that one that tells them, here's what you're supposed to do in this moment.
Yeah.
And that's what you're paying me for.
Yes, sir.
Not to just tell you to stay the course.
Right.
Stuff like that. I do need to still know about all the other things that are out there and recommend what's good for you. But there is certainly a value that people don't realize that until they experience it. And then they go like, oh, now I understand
Now
why
I get
I'm paying
it.
this.
It makes sense now.
Yeah.
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 So based on what you had said previously, you don't have to be a millionaire to come and I'll be your financial advisor.
No.
Do you see, or like, what would you say is a typical minimum that somebody average should be investing each month? Like, what's your lowest client that puts in like the lowest money? If you
I mean,
don't
I've got
ask it?
clients that are putting in $100 a month.
Yeah. I was just,
Oh, okay.
I mean-
Wow. So that low.
I mean, I've got clients that are putting in thousands of dollars a month. I've
Okay.
got clients that are putting in $100.
yeah. I mean,
I've got some clients that are putting in nothing, but they gave me $3 million.
yeah. So there you go.
So,
Okay.
Yeah, but
it's
if
kind
I
of
throw you $3 million at 40 years old, and I'm like, I'll see you when I'm 50, Kyle.
Mm-hmm.
Yeah.
You know what that looks like? Compounded, bro. Even at a 7-8%.
Yeah. You threw out a double-digit number, not unattainable.
It's no, it's not. It's not.
I mean, if you're doing a lot of the day trading stuff like you are, then I mean, you could have like a triple digit.
Yeah, but I manage my own account, and
Right.
it's
And there's a lot of
I got no hair from it.
but it's
You know?
a lot of time, effort, and energy that you have to put into it.
Kyle, I was at stroke levels yesterday. At stroke level between
should
between 9:30 and 10:30. Between 9:30 and 10:30, I did 20 trades. Sold buy, and it was just like, and you don't understand, bro. That hour is like surgery, bro.
Years
It's
off your life.
Yes. So if I had 3 mil to just be like, here you go, Kyle, you can get me back 7-8% on the low end. That's cool, bro. That at 7, that's 21. That's 210 grand.
Yeah. You're gonna have as much gray in your beard as I do by the
Oh
end of the week.
shit! Tell me about it. Tell me about it. You know, but yeah, man, I get it. I get it, man.
Yeah, but there's not like some rule of thumb, because really it all boils down to what you need for you and your lifestyle and your family and all that is different than what I need and he needs.
Yeah.
So if somebody comes in, people ask me all the time, "Hey, how much do I need to retire? Or how much does it cost you to live?"
Did I not just tell
Yeah.
you that the other day,
Yeah,
Joe?
you did. Yeah.
You know, if somebody has a $50,000 a year lifestyle and they got $1 million, they'll probably be fine.
I got buddies that sorry.
Yeah, go ahead.
I got buddies that are like, bro, you got the potential of making 30, 40, 50 million. That's great. But at 46, Kyle, I don't want to chase 30, 40, 50 million. Like, I know where I come from and I know where I'm at. And I'm more than satisfied with where I'm at. Like, if more comes, great. But I'm not chasing anymore, if that makes sense.
Yeah.
So,
I mean,
to answer what you just asked, it's totally up to you, bro. Like,
Yeah.
do you need a new Nissan Altima every 4 years? Then cool. So then you need this. Are you looking to buy a new Bentley every 2 years on a lease that costs you $4,000 a month? No, seriously. Like, where are you at? What do you need? Do you have a 5,000 square foot home for you and your wife? Well, then that's on you.
yeah.
I'm okay with a 2-2. If it's just me, you know what I'm saying? Like, there's levels to this shit. There really is levels to this retirement
Yeah.
stuff. And you got to ask yourself, what do I need?
So with that, you say $100 a month, right? That they're investing. Do they have to do it every week, or do they just do it one time a month? Auto drafting,
The
or how does that?
frequency is
Completely up to you.
really up to the client.
Yeah.
Oh, okay.
Whatever they're capable of doing or whatever they want to do. I mean, we can do it.
Sure.
A higher frequency if they want to.
Got it.
But, you know, to kind of touch on that same, like, how much do you need sort of a deal?
Yes, sir.
You know, as a financial advisor, I'm not just giving people investment recommendations, but I also have a financial planning software that I run, eMoney. It's like the one of the industry standards. There's like two big boys, and eMoney is like the top one that helps me. It's not rocket science.
Right.
There's only few things that we can control.
Yeah.
But if somebody comes to me and they go, "Here's what I got. Here's when I want to retire. Here's how much I want to live off of in retirement. Here's
What can
the
you do for
income
me?"
resources I'm going to have, and here's how much risk I want to take."
Yeah.
Well, we can adjust a few of those things, but this is an eye-opening experience for a lot of people because they come in and I'm like, "All right, I put all the stuff in, and it gives us a probability of success." So that probability of success comes up, and it's like 0 to 100. So 80% is going to be when you're in the green. 80%. You're feeling pretty good.
Sure.
It doesn't have to be 100%. Okay,
right.
80%. That's a passing grade when it comes to a financial plan. But when they see 23%, and they're all of a sudden they're like, "What do I need to change?" Real quickly, making a couple of little changes.
Oh, yeah.
They're panic mode right there. They're like, "Oh my God, I got to retire in 5 years. There's no way I can make up that gap." Well, hold on. What if we change this? What if we change that?
Yeah.
Do you really need $250,000 a year?
Yeah.
Or you just been accustomed to making that?
That's right.
Or are you going to be able to live off of this? How much you got coming in from Social Security? Do you have fill in the blank, right?
Absolutely.
And then all of a sudden, we're seeing that meter go up. Okay, well, I'm not going to ask somebody to take on a lot of aggressive risk in order to make up the gap. But sometimes, and we'll talk a little bit about QQQ, is really an excellent addition to a lot of portfolios to up the overall return without increasing the risk a ton. You know, if you had your cruise on 75 center lane on the highway, and you went from 75 to 79, is that a huge amount of risk that you're taking? If you went from 75 to 99,
Right.
now all of a sudden, hey, you're way past the speed limit.
Yes,
You're
sir.
probably putting yourself in more
Danger.
risk and danger
Yeah,
than
you're in danger,
necessary.
yeah.
But if you go from 75 to 79,
We're good.
but
We're good.
now, not only are you going to get to your destination a
And
little
it's safe.
sooner, but you weren't taking on a ton of risk to
Yeah.
get there.
Nope.
So that's how that investment has been a great complement to a lot of portfolios I'm working with clients. I mean, it's not the end all be all, but it is something that it fits
Yes, sir.
for a lot of people.
No, that's beautiful. That's
Yeah.
beautiful. I'll share something with you. I closed out 24 with a 62%
Oh, wow.
return.
Yeah.
But that's self-managed, and that's watching it every day.
Mm-hmm.
Like, let me move this. Let me do this. Let me go from here to here, like you were
Mm-hmm.
just saying. Let's move this around. And that's a nasty number, bro.
And what
You
did QQQ do in 24?
I don't have any QQQ.
Okay, I think it did like 30 or 40%.
Yeah, it was up there for sure.
So you were
I
busting
don't have
your
any
ass.
ETFs.
Okay.
Any.
Well, you were busting your ass to get that 62%.
Oh God,
okay?
was I? Yeah.
And then if somebody put their money in QQQ, just
Right.
as a, hypothetical here,
Yeah.
and they got 38 or 40,
Right.
hands off, didn't have to do anything.
Come on.
Yeah, that ain't bad.
Come on.
Right? Now, there's a lot of risk.
Can I tell you
if
something?
You put it all into that. Yeah.
I would have rather have gotten back 38, risk like not touching it,
Yeah.
than the 62 going crazy.
Yeah.
Seriously.
I mean-
as a matter of fact, I'll take 30 over 70 and not have to manage it.
You're doing my job for me, man.
I'm serious, Kyle, man. Like, if you can find a financial advisor like this man right here and give him $100 a month, $100, whatever it is.
100,000 is cool too. So.
100,000. 100,000 is
million.
I mean,
whatever you got, just scrape.
but I'm just
look at
saying
the couch
for
cushions.
that 18-year-old who, because it blows my mind. I have kids come up to me, 18, 19, 20, and they're like, hey, man, I'm really interested in the stock market and I want to grow some money. For an 18-year-old kid to come up to me and ask me that, to me, it blows my mind because 18-year-old kids just want to know, man, I want to go play some Fortnite.
No, that's great. If
So
there's kids that are really
when I
wanting
find
to-
that kid and they come up to me, man, I put them right under my arm and I'm like, let me show you the way.
Yeah.
Let me show you the way. And I have. And Joe knows I've turned a
vouch
few
for that.
millionaires, 20-year-olds into millionaires.
Yeah.
Because they got the money. The money's coming in from YouTube and from all these revenue streams, and
Yeah.
they don't know what to do with it. They just like, look. And I'm like, bro, if you put that here,
I mean, have you heard Shaquille O'Neal's story?
oh, God.
He was, I want to say it was his advisor or banker or somebody
Yeah.
called him up and basically read him the right act and said, look, dude, you're going to be broke. You're going to be another statistic. You're going to
Statistic,
be an
yes, sir.
embarrassment.
Yeah.
If you keep going this way,
Yeah.
you got to start investing in and diversifying. And the next thing you know, I mean, he's a ultra billionaire. He's involved in hundreds of different companies.
Everything, Kyle.
Papa John's, for heaven's sake.
Yeah.
So, I mean, who would have ever thought?
He owns 150.
Shaquille O'Neal.
He just bought Reebok. He bought Reebok. Not
Yeah.
I think like
Reebok.
last
He
year,
owns
yeah.
150 Mr. Car Washes.
Yeah.
I mean, the guy's just the general, like everything. He's involved in everything. He owns Forever 21. He owns a big chunk of Forever 21.
And the way that he got there was because he did have a lot of money.
Yep.
Okay. But he wasn't spending it on Lambos.
No, of course
and
not.
like $1 zillion.
And if he was, it was coming in from those assets.
Yeah.
It wasn't coming in from earned income.
Yeah, I mean, he's,
You know?
he's one of those people that's like a Mark Cuban now that is so diversified.
Yes,
Like,
sir.
He's got a team of people that has a team of people that
Can
has
you
a team of
imagine the team that he has around him?
Yeah.
Has to be amazing.
Yeah.
Has to be.
But that type of wealth is not something that everybody can achieve.
No, for sure.
But you can achieve things on a bigger scale than you think.
Yeah.
If you just start putting something away.
Yeah.
So next question is going to kind of go off the TAI scale. It's going to get a little hotter.
Okay.
All right. So what are your thoughts on a person who decides to do a little DIY in financial advising?
I mean, it depends on how much money we're talking about here.
agree.
People you've probably heard the phrase. I've got
Keep
a
throwing
million
them.
of these.
Keep
that I can
throwing them. I
pull
love
out,
them.
right?
I love them. Yeah.
Do
It's
it.
like, don't invest more than you're willing to lose, right? Like if you've ever been to Vegas, and I'm not gonna, make the complete comparison that the stock market is like Vegas,
Right.
but it can.
It
be.
can be. Of
Can
course.
be.
Yeah.
You know what you just said? I have it in another way. I said you should only invest fuck you money.
Oh, okay.
Seriously, don't go mortgage your house. Don't go refinance your car and pull out the equity out of it. Don't go take your kids' college money. Oh, they're only 6. By the time they're 18 and they need it, no, don't do any of that.
Yeah.
We're talking about that side money, that going to the bar money, the true fuck you money that you can take and play around with.
Yeah.
Yeah.
But don't you dare, bro.
Yeah.
Don't you dare go pawn your wife's ring. Like,
It's a beg from Peter to pay Paul type
come on.
situation you get
Come on,
into.
Kyle. You see, I fucking love this guy, bro. Shit, bro. This is exciting for me.
Man,
I'm
you're
sorry.
really boosting my ego.
No. I'm serious, man. Like, I don't really have people around me like yourself that can talk money. I've realized that when I talk money with some friends, they take it as showing off. But when I talk money around people like yourself, And we all get excited, like, oh yeah, yeah, yeah. What did you do to get to 62%? How did you do this? Like, and I just want to share. I just want to tell the world that's what we're doing here.
Yeah.
You know, and I love that, man. Like Joe knows. I know his mind is a little different now since we've been hanging out, and it's just like you got to look at money different, Joe. You know, you have
I
to.
could tell kind of, indirectly because of some of the questions that he started to ask me when I'd run into him.
Yeah, yeah.
And I'm like, where are these questions
Coming from.
And I showed you the when I showed him the Beyonce podcast, the interview that we had, he's like, I gotta come on here and destroy this man.
Yeah. No, and I was excited for it, man, because like I said, I'm not an educated man. You know what I'm saying? I'm a ninth grade dropout. I don't even have a GED. You know, so I'm literally self-taught. You know,
but you're a hustler.
Yeah, but my ears are always open, and my mouth is always open because I believe that closed mouths don't get fed. And if you're not listening, you're not doing a job, bro.
Yeah.
Surround yourself around people that you want to be like. You know, if you surround yourself around 4 crackheads, I guarantee you become the 5th. But if you surround yourself around 4 millionaires, you will become that 5th one. I don't know when, but eventually.
Well, it's kind of like that book, Atomic Habits.
I have it. I don't know where it's at.
Do you?
I have it. Yeah, I have it.
There's a lot of things that it's just getting yourself into some of these behaviors.
Yes, sir.
That will start to see, like, how has this person been so successful? Like, what are they doing? And then when you start to really analyze what those behaviors are, that's the magic.
Yeah. I'm with you.
So,
I agree.
yeah.
I agree with that.
Yeah, DIY, I mean, there's nothing wrong with that. There's plenty of different, Robinhood or
Webull.
There's all kinds of online platforms.
There's a ton of new apps, yeah.
But it doesn't mean that you need to be doing your level of day trading.
Right.
Okay.
Right.
That's not what somebody needs to start out with.
No.
Yeah.
They need to start out with something where they're doing a little DCA, a little dollar cost average.
Yes,
all
sir.
that means is just putting some fixed amount of money in on a regular frequency.
Yeah.
And the thing that you get from that, so kind of the logic behind it is the prices are going up and down every day.
It's a roller coaster. Absolutely.
So if you're buying at a consistent frequency, sometimes you'll be buying that and it's at a lower price than you bought it last time.
Absolutely.
Sometimes you'll be buying that and it's a higher price than you bought
Yep.
it last time.
Yeah.
So you are lowering your overall cost basis
Yes, sir.
over time if you dollar cost average, and all of a sudden you look up and you go, hey, how did I all of a sudden save hundreds of thousands of dollars, millions, because I stuck to these behaviors and I just kept putting it in to the machine. And if you have quality investments, then it's going to produce results for you.
I was just watching an episode of Dave Ramsey,
Uh-huh.
and some older lady calls, and she's retiring. She's like, I'm getting XYZ, and I had this account that I had no idea my husband left me behind, and he was investing into it forever. It was Walgreens.
Uh-huh.
Long story short, there was $3.8 million in there.
Mm-hmm.
She had no idea about. And that's the thing. When you invest and you start early, don't look at it. Don't babysit it. Just throw at it. Just throw at it. Just throw at it as if it was that cup of Starbucks or that drink at the bar. Just throw it the same way you throw it at the bartender. Throw it into that account.
Mm-hmm.
And watch magic happen, bro.
Yeah.
The magic that happens is unbelievable. The way I talk today, 10 years ago, I'm not that person. I wasn't talking like this. I was still on the put it in the savings at 0.056%, you know, like over at Chase. Thanks, by the way. Maybe it's up to 1 or 2% nowadays. I don't know. I don't ever want to know because I'm never putting money in savings. Maybe that's wrong, but that's just the way I look at things. I don't know.
Well, I mean, as long as you've got liquidity,
Of course,
then,
yeah.
then that's fine. Where that liquidity is up to the person.
For sure,
Yeah.
for sure.
I mean, having some sort of an emergency fund, that's like a big Dave Ramsey, like fundamental that he'll harp on. It's like you got to have X amount. But sometimes I have clients that will take that to, I think, too much of an extreme level.
Okay.
Where they'll say, I got to have 6 months worth of like income set aside, and they'll have, $75,000 sitting in a savings account, making them not. I mean, right now savings rates are okay, but before $75,000 sitting in because they're like, well, I need to have 6 months worth of income. And I'm like, well, you can still have the money in a position that's growing at a rate better than what a savings account is, that is not taking on a lot of risk, that is very accessible to you. Because if you don't end up needing that emergency money, what could it have been doing for you?
Well, not
How
only
long did that emergency money sit there? It sat there for 10 years and it didn't do anything.
Nothing.
You could have that 75 could be worth 150 now.
Joe, Kyle, the dollar from 2020 isn't worth what it is today.
Yeah.
That money in saving isn't worth the same. It's never going to keep up with inflation under your mattress or in your savings account. It's never going to keep up. It has to be invested. Because let's just throw out a quick example. Back in 2020, gas was $2 a gallon. Now we're at about $4, right?
Yeah.
So if you had $1 saved in 2020, that was half a gallon. Today, what is it? A quarter of a gallon. So
Yeah.
it lost half its value.
Yeah.
You have to invest.
So that whole cost of living that you're kind of touching on there, there's really 3 bullet points to it.
Please.
So you've got inflation
Yeah.
is one of them. You've also got planned obsolescence.
Okay.
Okay. So things wear out. So the next time you got to put a set of tires on your car, you're like, damn,
Yeah.
it's $1,200 to put tires on my car. I'm not putting on a like a Ferrari. What's going on here? Last time I put tires on my car, I thought it was like $600 or $700. Now it's $1,200. So you got this planned obsolescence, stuff wears out.
Yeah.
Then you've got technological innovation, which is only going to continue to boom.
Yeah.
So we graduated similar time frame. So
Never graduated.
Well, close enough though. Some of the hardest workers.
I graduated out of
most
middle
successful
school.
people. Yeah. So think about let me do the math real quick. 30 years ago, did you have a cell phone?
I got my first cell phone late 90s, I want to say. Yeah, like
So it might have been around there, but
99.
So most people didn't have a cell phone 35
and it was a
years
tiny
ago.
little flip.
Right. So you didn't. Nobody really had one back then. So you
No.
know what else they didn't have? They didn't have a phone bill.
Yeah.
So now we've got. When's the last time you put a VCR tape in?
Yes, tell me about it.
I mean, do you even own a VCR?
No.
Do you even use DVDs anymore?
No, none of that.
Did
None of that.
you have a Netflix subscription, Disney Plus, Hulu,
Right.
HBO Max, all of the Amazon Prime? You didn't have any of those subscriptions.
You're right.
Back then.
You're right.
So all this technological advancement comes with additional costs. When we were kids, TV was free.
Yeah.
Okay. So now, not so much the case. So we've
Unless
got.
you had a hot box. I had a hot box, and I would go between channel 62 and 63, which was the porn channel, just to catch the little blur. Just, oh, that was a titty. That was a titty.
Everybody waited for the squiggles
Hell
to
yeah.
settle for just a
I'm
second.
just keeping it
We all
real.
have the same image in our
if you
mind right
wasn't
now.
10, 12 years old and flicking like, oh man, there it goes.
I feel like we're
Completely off topic. I'm sorry.
kindred spirits here. We're gonna cut that out. So anyway, yeah. So the whole cost of living deal.
Yeah.
It's like those 3 things. So inflation's definitely a big piece of it.
For sure.
But these other things that you go like, oh, okay, yeah. I mean, yeah, stuff wears out. We bought a Yukon back in 21.
Okay.
And I was like, golly, I didn't realize how expensive cars were now because it'd been a few years since we bought a car. And so I've got kids. One of them's going to be driving in 3 or 4 years. And it's like, okay, well, she's going to get probably my car and I'll have to buy a car at that point in time. But, this, having to just replace things and the cost of those things going up because of inflation and what have you. So it's a vicious cycle. But if we've got... People think like, oh, is this sustainable? Like from an economic standpoint,
Right.
Like as a culture and a country and all that sort of stuff. Well, it depends on, are the companies that make up the fabric of our markets profitable?
Yes, sir.
Are they doing okay? Yeah. If they're doing, people are like, oh, the world's going to come to an end over whatever, economic thing or political thing. I'm not going to get into politics.
Kyle, this is a good one because when people ask me, how do I invest? My response is, are you in debt? And I ask that because of this. Let's just throw out a number. Let's say you got $20,000 worth of credit cards and you're paying 17 to 28%. Would you tell your client to invest at that point, even though they're in that kind of debt?
I would tell them they got to get rid of that first. And here's why.
That's my answer. I won't let you invest until you get rid of that. Because your investment might get you back somewhere between 7 and 13% realistically. What's the point of saving $100 a week, which is 200 a month, a year, sorry, when you could take that 52 and put it towards that damn note that you got that's killing you at 18 to 28%.
So that rate is the thing that matters the most.
100%.
If they've got something and the rate on it is 3%.
Oh, forget it.
Well, then guess what?
Now we're good.
You're investing.
Yeah.
Because we're going to make you a return greater than what it is that it's costing you.
Yes,
over
sir.
here. That's how a lot of the people have really leveraged their assets in a way that they go, okay, well, I would never advocate taking a loan out to invest,
Right.
because that would be unethical and fundamentally unsound, but it happens all the time. And so if somebody has, other liquidity, but they say, hey, I want to use the leverage of this here so that if I'm not going after anything super aggressive, but if it's going to be a 3% rate that I'm paying on it, but I might be able to make 7, 8, 9, 10, then the difference between those two certainly justifies investing. But if they're paying 28% on a credit card and they're saying like, hey, I'm going to give you $500 a month.
Don't.
And I'm
Please
telling
don't.
them like, well, based on what we're doing here, we're not going to be doing more than about 10 on an average. Then it just doesn't make sense to invest at that point.
I don't know why it sounds so much better coming out of your mouth from when I say it to people, because I know because I just said that, but it just hearing it, like verifies what I've been talking
Yeah.
about. It doesn't make no sense.
Yeah.
You should not be investing if you have debt.
Yeah.
And I'm talking about bad debt, not good debt. Like your home is good debt.
Yeah,
Because you need a place to live. Like that's your home, Your car, it is what it is. But like credit card debt has to be gone before you start investing.
Yeah.
Because it's what I call ass backwards. Yeah. You're saving for maybe 7 to 12%, but you're
28%.
but you got
interest.
credit cards that are 18 to 28%.
Yeah. There's some legislation where they're trying to get it down to
I
like a
saw
flat
that.
number.
I saw that.
I doubt that that's ever going to.
You saw Visa just passed $1 trillion in debt.
Oh, wow. I don't think that they'll be able to pass that sort of a deal though, because they'll get so much pushback and fight on it.
Yeah.
That I mean, I don't think that it's right. The level of look, I'm all about free market capitalism,
For sure. Me too.
but also I don't want people to be taken
Advantage of.
I
Yeah.
don't want people to get hurt
Yes, sir.
just so that this other company can prosper.
Yeah.
So it's kind of like
Yeah.
straddling some of those political fences.
Yeah.
But end of the day, I just want people to be able to take care of themselves. And if there's something out there that's hurting them, because they find themselves in a position where they're buying groceries with a credit card,
Oh man.
and the next thing you know, it's just snowballed on them to a point where you just can't climb out.
Yes, sir.
Yeah. So there's a lot of influencers, YouTubers that are in the financial space. A lot of them have Discords, and for a fee, $5-10 a month, whatever it is, to access, let's say, that portal, they pretty much, the person that's there is showing them their trades, what tomorrow you should invest in, and they're paying like $10-20 a month, whatever it is, for some of these Discords. What's your thoughts on something like that?
So I can't do anything like that.
That's
based on
gambling.
my
That's
licenses
gambling.
and regulations.
Yeah.
And those people are not licensed professionals.
Nope.
So it's kind of like, hey, I know a guy that can do great woodwork, but he's not a licensed contractor.
Right.
So he builds your house and your house falls down.
Mm-hmm.
And then all of a sudden you're like, hey, man, my house fell down, and he wasn't licensed, bonded, insured.
Yes, sir.
And you're like, man, I really probably should have gone to a pro
Yeah.
that had all of the licenses and like all of those sort of legal things in place.
Yeah.
Yeah.
I mean, if you want to follow somebody and like take their advice with a grain of salt, go for it.
Sure.
But I don't know that I would put too much weight in somebody's opinions like
I
that.
agree. I agree 100% with that. I agree.
Great answer.
Because those Discords
Great answer.
is if you look, they're usually young kids, and by young I mean like 18 to 25. And those are day traders that are on Xanax and just like, yeah, let's get it, let's get it. And it's just like that's a dangerous game, bro.
And
Dangerous
blanket
game.
financial advice is a big fat no-no.
Yeah.
There's no blanket financial advice. Oh, everybody should buy this. No.
No.
That it can't exist.
Right. Of
Because
course.
what you're doing there is you are
Your job wouldn't exist if it was like that.
right. Of
course.
You're avoiding all of the suitability and appropriateness type boxes that you need to check.
Right.
To see, is this right for, is this idea right for a little old lady that lives down the street? Maybe it is a good idea
Sure, for her, yeah.
25-year-old kid
Yeah.
or something. But I don't know that I'd put a whole lot of give that a whole lot of attention.
Yeah, I agree.
And let's say for someone that self-invested in the stock market and they did well in their return, do you think that regardless of what their return was, you could have turned it around at a bigger profit?
That's kind of a moving target,
Yeah,
right? So it depends on like how aggressive they were. I mean, if they're investing in IPOs and stuff like that,
Right.
then it's like a Monday morning quarterback, right?
Right,
It's like,
right.
well, if I was out there, I'd have done this. I'd have thrown that touchdown. I'd have thrown it to this guy that was wide open. It's like, well, yeah, but I mean, you weren't in the game at the moment when it mattered,
Right.
right? So it really depends on what they're pursuing. I'm not an advisor that uses really aggressive strategies. I do have some strategies that are more growth oriented, but they're not super aggressive. And if somebody does want to get into something that is a higher risk profile, those are kind of one-offs. But, could I have beaten their return? A lot of times what I'll do is when somebody brings in their portfolio and they are invested with another firm somewhere, maybe they were doing it on their own, maybe they had it at a firm somewhere. Right. I'll say, well, show me what you got. And I will show them, here's what I would be recommending to you now.
Right.
And then let's see how it did. So I'll hold my own feet to the fire and say, okay, well, your thing did 11 last year. Let me see what my idea did.
Yeah.
Oh, my idea did 10. But what did it do over the last 10 years? What did yours do over the last 10 years?
Yeah.
If yours did, because you might have one year where it's like a huge pop and you're like, yeah, I did 42% last year. You're like, okay, well, what did it do the year before that?
Mm-hmm.
Was it down
Year after year.
68?
Yeah.
That's right.
Yeah.
Right.
Okay, yeah. I mean, it's like that person that goes to the gambling all the time, and they're like, "Oh,
I'm
yeah,
up
I made
$1,000.
I made $10,000.
How much you put in?
Did you lose last
How
week?
much
How
you
much
put
you in
in
for? Yeah.
Yeah.
Well,
How
I'm
much
in
did
for 25.
So you're down 15.
Right.
And that's the stupid smart person that I'm
But
talking
what
about.
you hear is the I made.
I
this.
made. No, you didn't.
There's more to that
Oh,
story.
my
There's
God.
always more to that story.
I think we just became best friends. For real, man. For real.
So, I mean, sometimes the answer is, yeah, I could have beat it.
Yeah.
But it's like, let's unpack that a little bit and let's give it some real context to make sure that the answer I'm giving you is, relevant.
You know what it is? People are looking for that unicorn. You know what the return on Nvidia has been in 10 years? Google this.
I'm sure it's, I mean, I've got it right here.
I want to say it's 26,000% in
crazy.
10 years.
That's crazy.
They said that if you would have bought a PS4, the same $400 that you bought a PS4 for 10 years ago, if that invested would have been something like $1 million something today.
That's crazy.
You were super close.
What was it? What was the percentage on it?
23.5.
23,000%, Kyle.
Yeah. So
That's a unicorn.
this is a good opportunity to talk about the QQQ
Let's do it.
deal that we were talking about.
Please.
Because of QQQ, so QQQ is a ETF, exchange traded fund. So exchange traded funds are kind of like a mutual fund,
Right.
but they're going to be more passive. Passive meaning there's not some fund manager going in and buying and selling stuff all the time.
Right.
It's somewhat of an index,
Yeah.
but it's an index that's been created by, and Invesco is the one that put QQQ together, that says, all right, here's what the holdings are going to be.
That's right.
So they take the NASDAQ 100 index, and then they also have, that's 50% of the portfolio holdings. The other 50% is made up of 10 stocks.
Yep.
So some of the, like, here's the best stocks to pick from or something like that.
Right.
I think you'd asked me that earlier, like, are you comfortable with saying, like, here's the top best stocks to pick from? Why don't we use QQQ as an identifier of what are some that you might give some attention to?
You know how I explain that to people? Take a basket, right? Like you're in the mood for fruits, oranges, bananas, apples. That's what an ETF is. It's a basket with all the fruits and vegetables that you want.
Yeah.
Pretty much is what it is.
Yeah.
Like if you're like, man, I really want to invest into Tesla, but man, I like Nvidia, but I also like CoreWeave, but I like this. Well, guess what? The S&P 500 has the top 500 companies all in one basket. There you go. Problem solved.
Yeah. So investing in an index can definitely be, if when in doubt and you feel like I just don't want to screw up,
For sure.
an index is definitely a good way to get started.
I agree.
QQQ is a way to take that index philosophy and then add a little bit of more horsepower.
Okay.
And so the top 10 holdings of it are Microsoft, Apple, NVIDIA, Amazon, Meta, Broadcom, which a lot of people might not have heard
Oh
of
yeah,
before.
Broadcom is amazing. Yeah,
Google, Tesla, Costco, and then it's like Google A and Google B. So it's like there's two Googles
For sure.
that are
Yep.
Alphabet or whatever you want to call it.
yeah, Alphabet. Yeah,
that are in it. So those right there are 50% of the QQQ holdings. So when you look at some of this long term, you were talking about Nvidia's like 26,000% over the last
10
however
years.
long.
Yeah,
So, quick comparison. So, the Dow Jones over the last 10 years is, and these are numbers as of today, is up 130%, almost 131. So, if somebody said, I'm just going to put my money in the Dow, they'd have made plenty of money.
Absolutely.
They'd have made a pretty darn good return. It would have averaged probably
about
over
11% a year, 10.5%.
Yeah, once you get the averaging, the compounding in there, maybe a little bit less, but still close to double digits.
Still amazing. Yeah,
All right, let's take it up a notch.
Yep.
Everybody might not understand that the Dow is not the best benchmark to use.
I don't
it's
like
the big number that everybody follows.
right.
But the Dow, they're like, oh, the Dow is up 300 points. The Dow is down 1,000 points. Whatever. Don't let that be the end all be all for you.
Yes, sir.
There's only about 30 stocks that make up the Dow average.
Yeah.
The Dow Industrial Index. The S&P 500, much better benchmark to use.
Yes, sir.
Over the last 10 years, S&P 500 up 175%.
We're talking 10 years.
10 years. All right. Let's look at the NASDAQ before we get to QQQ.
Okay.
So the NASDAQ is up 270 over the last 10 years. 270% over the last 10 years.
That's average 27%.
A lot of volatility that you might be dealing with there. Yeah. So more ups and downs.
Yes, sir.
But then let's look at QQQ. So we just, what did I just say? 270?
Yep.
Yeah.
QQQ's up 362% in the last 10 years. So if you have something that is not quite as aggressive as QQQ, and people say, well, how can I beat the market? Yeah, well, you might have to take on more risk than the market.
For sure.
So what if I was able to show somebody a portfolio that wasn't as aggressive as the S&P 500, but when you marry QQQ into it at whatever percentage that we agree upon,
right,
and we say this QQQ did more than double of what the S&P did over the same last 10 years. So we're not just looking at Monday morning quarterback. Oh, what did it do last year? No. We're looking at a big enough collection, like sample size.
Yes, sir. 10 years.
See, like, is this a reasonable and fundamentally sound investment to be able to use?
Yeah.
Yes, absolutely is the answer. So you marry that together with it. Now all of a sudden somebody's able to say, hey, maybe I can meet my retirement goal by changing some of my investment strategy.
Yeah.
And now instead of going 75 in the center lane, I'm going 79. I didn't really up the risk that much,
but it still went up.
I'm capturing so much more. And especially in times where we've had these big declines and big increases, this is a really kind of a cool number to look at. The Dow Jones year to date. Okay. So everything was looking good at the end of last year, and then the bottom fell out, and everything was bad this year.
Right.
For the most part, until it turned around pretty quick.
It did.
The Dow right now is only down 1.8% for the year. No big deal.
Nothing. It's only May.
The S&P down 1.1% for the year.
Yeah.
Nothing. QQQ is down more aggressive.
Right.
Down 0.19.
Nothing.
Basically,
literally nothing. Break even.
Okay. Yeah. So yes, it's more aggressive.
Yeah.
But because it's more aggressive, and because we have the circumstances we've had in the market, and the market did have somewhat of a flash crash and a flash rebound, then you captured it. Yeah. You know, if you got a flat tire, you're going somewhere, you have a destination you're trying to get to.
Yes, sir.
You got the flat tire. Are you going to abandon your car on the side of the road and be like, you know what, I'm cashing out? No.
You're going to
change the tire. You're going to get back on the road.
That's it.
Keep going towards
your destination. Keep it moving. Yes, sir.
So you got to have, some balance of the different investments that you have.
Agree.
I don't ever suggest put it all in one basket. I mean, everybody has heard that phrase before. Don't put all your eggs in one basket. But I mean, the fundamentals of investing is to have the right amounts in the right baskets.
Yeah, agree.
And that's what diversification or asset allocation really boils down to.
I think I'll come to a point where I'll do that when I'm like around 50, because that's where I plan to retire. So at that point, I'll knock it all out, take it all, and be like, boom, leave it there, and just like an ETF, and just let it do what it does. Because I can't go through. 2 nights ago, I was up to midnight researching, like, oh, what am I gonna trade tomorrow? What am I gonna trade? To the point that I was so excited, I fell asleep excited, woke up at 5, and from 5 to 9:30, just researching, bro. And that's when I did 22 trades between 9:30 and 10:30, and I could have ran 10 miles, bro, after that trade. I was so hyped, my blood, it was just like pumping.
Now I see why you got all these Monster Energy drinks here.
Love Monster.
You know, something that you said that I really like and that people need to understand is that when you retire,
Right.
it's not like you're cashing out and sticking it under your mattress.
No,
You're gonna
no.
keep that invested.
100%,
You
yeah.
have to.
Yes, in order to.
Because what we want to see, if people say, well, they don't want to see their account go down in value. Well, if we are taking a reasonable distribution rate out, the rule of thumb, 5-6%.
Yes, sir.
If you're taking somewhere out between 5 or 6% and you're making 7 to 10, then you're going to do a little bit better than break even.
Yeah.
There's another thing that it's called the law of losses that I think it's important for people to understand. It's easy math, though. So hypothetically, somebody's got $100,000 invested.
Okay.
Account's down 10%. You got 90.
Okay.
Account goes up 10%. You got 99. Hold on a second. I had 100. It was down 10. Now it's up 10. Well, you had less.
Yeah.
So you got to make 11 and a half
Yeah.
to get
In,
back
in order to get back to that
to
100.
get back to that.
Yeah.
So making sure that we are, look, if we're taking out 5, we got to make 6, 6.5 to keep it at an even keel.
Yes, sir.
So what is your estate goal? How much you wanting to leave to your family, if that's a priority to you or not? If not, then, you know, I have some people that are, you know, single widows that don't have any family, and they go, I don't have anybody that I'm leaving this to. I'm leaving it to the Humane Society or to St. Jude's or whoever it is. Yeah. So it's okay to up their distribution rate to make sure that it can satisfy their lifestyle and give them the confidence that they're not going to run out of money.
My last property, the gentleman passed away, and I bought the house off of Jehovah's Witness. It went into arbitration. They owned it. That was that. Isn't that sad? You work your whole life, you pass away, and nobody to leave it to.
Yeah.
I mean, that's just the way the cookie crumbles.
Walter Crunk item.
There you go, right? Just saying, man. Just saying.
So do you feel as a financial advisor that you have kind of more insights or like, you know, like insider information than a average DIY investor would be? You know what I mean?
Cut that part.
Not like
Martha
that, but
Stewart, what are you talking about?
do you feel like you have better
You
resources
sounded
or
like
better
Trump right now.
information?
You should buy all the stocks. It's going to be like a rocket ship. I'm telling you. And he wasn't bullshit when he said that, by the
I
way.
was going to say, he's like, it's a great time to invest.
It's a
And I
great
was like, you son of a gun.
Yeah, yeah.
I thought it was funny because
It
I
was.
was like,
Like, the president saying that, it's like, damn near insider trading. That's crazy.
it was, I thought it was funny because, I mean, it's not like he said, hey guys,
Buy
this
this.
is about to happen.
Yeah, yeah.
But no, the short answer is no.
No, yeah.
But I don't ever have any sort of inside non-public information.
Yeah.
Now there might be information that I come across that not everybody knows about, but it's already public.
Yep.
Yeah.
You know, there's plenty of things. They're like telling somebody about QQQ that they've never heard about it before.
Sure.
Then they're going like, oh yeah, that's information I didn't know before now.
And I guarantee you there's someone out there right now that's going to watch this that had no idea what that was.
Yeah.
Yeah.
Because the most popular ETF is the S&P 500. That's what everybody knows, the S&P, the S&P.
Yeah.
And I'm like, what is that? I don't know, just people always talking about it.
Yeah.
What are you talking about then? What are you telling me? You know?
Well, I mean,
So-
back to understanding what it is that you own.
For sure.
You know, you
Sure.
got to understand, at least in some way, what it is that you own. And I'm actually a proponent of people investing in things that they consume in their world.
Yeah.
You know,
Agree.
so if you love Apple products,
I
then
told
invest
you
in Apple
this. I
products.
told Joe that.
You know?
I said, buy what you love.
Yeah.
You know? Buy what you love. That's it.
It's basically putting your money where your mouth is.
100%. 100%.
Minus ETFs. Let's talk about single stocks. What, in your mind, are the 3 best stocks as of right now that you like to invest in?
All right, so I'm not going to tell you exactly which stocks to pick, But what I'm going to tell you is we're going to educate you a little bit on the
Like this.
some of those buzzwords or vocabulary words,
Yeah, yeah.
the beta, the PE, the
The forward.
the standard
Standard.
deviation.
Yep.
So let's just pick one. Like, give me a company.
Tesla.
Perfect. All right, Tesla. Right now, their PE ratio is 195, and you go, is that good?
Yeah.
Is that low? Is that high? What is that? So the PE ratio is going to be a relationship between the price of the stock and the earnings that the company is producing. So that relationship, depending upon the industry that they're in, they can trade at a higher what they call multiple. So more growth oriented industries, tech, stuff like that, higher multiple because they've got a lot more growth opportunity there. If you've got like a good old fashioned like Johnson and Johnson or Procter and Gamble or Walmart or somebody like that, they definitely have a prospect for growth, but they're not some big exponential type growth company. So each industry is going to kind of have their own range that the PE will fit into. So 195 is pretty high.
Yeah, it is.
Even for a tech company
is.
or
It
for
is.
I mean, because Tesla is
It
a
is
lot
tech. Tesla's tech.
Yeah, I
I
mean,
wouldn't even
yeah.
consider it a car company.
it's
It's a tech company that makes cars.
yeah, I 100% agree.
Yeah, yeah.
Because all the AI and things of that sort that are probably going
The
on behind
robots, the
scenes
robo
there.
taxis, and all that. Yeah.
So if we're looking at just kind of rule of thumb, round numbers, if a PE ratio is like under 30, that's pretty good.
Yes, sir.
So another way to think about the word PE ratio is valuation. What is the valuation of this company?
Yeah.
Are they fairly priced? So when people go, oh, the market's high. Why? Why do you think that? Did you look at the PE ratio of all the companies in the markets?
Right.
Because right now the PE ratios of the market are pretty strong.
Yeah, they are.
Averaging somewhere around 25 or 30, maybe
Agree.
even less in some cases.
Yeah.
So that would tell me, yeah, we're still in growth mode.
We are.
You know, if the PE ratio of the market was 100, we are in a bubble.
For
Right?
sure.
If that was the case, that's not what we're in right now. Their PE ratio is at 195. So you got to also consider the source of the company. And
Right.
you're like, okay, well, this is a company that I know that there's a lot of volatility. So that's when we can kind of look at that term beta.
Half the people that are investing into Tesla today are buying it according to the future of it.
They should be buying it. according to the
100%.
future.
Yeah, yeah. You're not buying it for today for what it is today.
Yeah.
You're buying it for what it's gonna bring.
Yeah.
You know. So-
Because you believe that they're going to continue to prosper, they're going to
Absolutely.
continue to innovate, they're going to continue to expand,
Yeah.
and that's only going to just add to their bottom line.
Their number is astronomical too in the 10-year rate.
Yeah. Oh gosh,
It's
let's look at it.
astronomical. It's
Yeah, so
crazy.
their 10-year number, 1900%. Now, beta is the other figure so we know what the PE ratio is now, right?
Yeah.
So before I move on,
Yeah.
if the PE is too low, we need to check that the check engine light's not on.
Qualification on the company.
Right.
Yes, sir.
Is the
Yes,
company
sir.
going out of business?
Yeah,
Like,
yeah.
why is it 7?
Yeah.
Why is their
Yes.
PE 7? Are they going bankrupt?
Yeah.
So or it might just be a fire sale. Like, hey, definitely pick this company up because the PE supports the valuation being either fair or undervalued if it's a really low PE. And
Yeah.
if it's high, then you go like, well, let's consider the source of the company, right?
Okay.
Beta is the other thing to look at to tell you how is this stock going to move correlated to the market. So a beta of 1 would be it's going to move equally to the market. So if the S&P's up this, you're going to be up
Oh,
that.
yep.
With this
That's right.
whatever fill in the blank stock is, right?
Yeah.
Tesla's beta is 2.4. So 2.5 times what the market is. So if
Market
the
is.
market's up, it might be up 2.5 times what the market is. The market's down, and you're down 2.5 times more than what the market is. I mean, imagine days where the market was down 4 or 5%,
Right.
and you're in Tesla's down, I don't know, 11, 14. There's been days where it's down 20%. That's the type of that's a volatility metric that we'd be looking at. So we got the PE, we got the beta, and then when it comes to like, you'll see standard deviation more when it comes to ETFs and mutual funds.
Yes, sir.
So the ETF, the standard deviation of I think the average is somewhere around 10%
Okay.
standard deviation. Tesla's, I looked this up because I knew you were going to ask me this almost. You didn't tell me, but I just felt it.
Yeah.
Is 20. So
Okay.
it's double
what
the
it should
standard
be.
deviation,
Yeah.
which
Yeah.
checks out because the beta is double what the markets would be. So those three things, then you don't need me to tell you what good stocks are out there. Yeah, so I think find some stocks that you understand the company, that you're familiar with them, you like what they do, and now you know what to look for to see, are they a good buy?
Yeah. Agree.
Is the valuation there? How risky is this? So does it align with how much risk you want to take? Because if you say, well, I'm okay with a little risk, and then you all of a sudden see that the beta is 2.5, so it's 2.5 times what you probably would experience with the market, they might go, oh, well, maybe I don't want to do much in that one. Or if I do, I don't want to put too much in that position. So having the right kind of balance is what those three different things will help you back your way into different stocks.
So essentially, that's kind of like your Google review.
Do your
Is
homework.
what that is.
Do your homework.
Similar to it.
Yeah, bro.
Yeah.
Yeah. And with ChatGPT today, you can ask it all these questions.
Yeah.
I mean, I don't think you should follow what it's telling you, but I'm saying for the most part, it'll tell you what you're looking at. It'll give you the answers to the questions you want to know.
Yeah.
Is that right?
Yeah.
Yeah. Yeah. So.
Yeah, I think all those things. It's like you've heard the phrase "trust but verify." So it's like, okay, well, but I don't know how much you can always trust ChatGPT.
Yeah.
These days, but I think that the AI is only going to continue to exponentially get better.
Better. Oh yeah. I think this is the beginning.
But it's up to us to be able to program it to. It has no way of checking itself.
Right. Someone's putting in that information.
So we got to make sure that it has some checks and balances as far as technological accountability.
I respect that. Yeah.
But I think bottom line is investing is a very individual, personal thing, and it comes down to experience, the amount of money that you're dealing with, your time horizon, which is a fancy way of saying how old are you?
How old are you?
And how much longer are you going to be working for? How long do we we don't have control over how long we're going to live, but if there's a life expectancy now of 80 plus to 90 years old, then we need to make sure that we're planning in a way that if you're retiring, like you were saying, at 50, then that's an aggressive retirement age for most people.
But by the way, I don't think I could ever retire. To the day I die, I will hustle.
Yeah.
It'll be something.
It's just in your bones.
Yeah, yeah. Like I'll be in a nursing home. Like, what's going on, sweetie? What you want to do for that wheelchair, girl? Huh? Like I will forever. Like by retiring at 50, I mean just taking it super easy. Yeah. That's what I mean by that. Because Joe knows I'm going at it from eyes open to eyes closed. So.
Well, that's one of the things about this world in this industry that I like about being a financial advisor. Is that I can take my foot off the gas, but still do a good job of taking care of the relationships that I've got.
Beautiful. And
still make a healthy income without having to grind.
Love that. Love that.
Yeah.
One more question. We didn't even talk about this. Do you dip your nose into crypto at all for investments?
I felt like that question might come up, and I don't, because crypto is still kind of in its infancy. Even though it's here, it's not really going anywhere right now. It's still in its infancy, and it's not technically a security.
Yeah.
So I am licensed to deal in securities. So there's not any sort of crypto type. There probably will be. Yeah. There might be some crypto funds out there and crypto ETFs that are out there right now, but that's not anything that I do. And it's not anything that I'm recommending to my clients right now, because it really starts to get into a whole nother realm of type of risk. Because if you think about, say, not a currency, but a company, okay? A company, we can look at those metrics. Do you have earnings? You can't look at Bitcoin and be like, hey, Bitcoin, how's the company doing? It's a currency.
Yes.
So what's driving that currency? Think about...
I'm completely against it. I'm completely against
Think
it.
about the correlation of, there's actually a pretty good correlation between gold. People ask me about gold all the time. Gold and real estate.
Right.
Inverse correlation. Why? Fear. When people are scared about real estate, gold is going up.
Oh, for sure. We just hit like $3,500 an ounce.
Can
which
you
was
go
like
to
an all-time
Publix
high.
and pay for your groceries with a bar of gold?
No, you cannot.
You know, they're like, oh, well, when the world comes to an end, I'm like, well, that gold ain't going to
Shekels. Here's some shekels. Yeah.
The world comes to an end. You know what you need? You need ammunition and chickens.
Oh yeah, you're
And
right
guns.
about that.
Because you need that's what. But I don't think that I'm not doing any doomsday prepping right now.
No.
Fundamentally, you follow the recipe, but be open to some new spices every now and again.
For sure.
Yeah.
QQQ is like one of those spice. It's not the end all be all.
No, for sure.
But I think, especially for your audience, and maybe people that have some experience, and they're going like, oh, maybe I should. I have heard of that. I've seen that commercial. Maybe I should give that a shot and see how that can maybe be a little bit of shot of horsepower into your portfolio without doing it irresponsibly.
Love that. Love that. Love that.
All right. Well, hey, thanks, guys. Joe, Ariel.
Sir.
Appreciate you having me here today. I'm Kyle Williams with Synergy Wealth Alliance. My practice is in Altamont Springs. Been in the business here for about 15 years, and if the type of advice that you've heard from today is something you think you could benefit from, give me a call.
Orlando, give this man a look. He's amazing. He sold me. Love you guys.
Cool.
Let that one sink in and think about it. Let's go.
Thank you.